The S&P 500 has been on an absolute tear this week, and the Santa rally is in full force. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our Elite webinar. Now, if you're watching this on YouTube and you haven't done so already, you need to get down there and click the like and subscribe button. Make sure you click the bell icon right next to it to get notified every time we upload a new webinar here on the channel. But I'm glad to welcome back Riz. How you doing tonight, brother?
Doing good, Chris. Good to be back. It's been a few weeks since I was last on, and what do you know? A lot's changed.
It always happens this way, honestly. Every time, Riz goes and does something, the market goes absolutely hog wild. And that's exactly what has happened here this week. It has been seeming like nothing but green all week. Now, obviously on Thursday, a little bit of a doji candle there, a little bit of indecision, whether the market wanted to kind of top out there. And it does look like we might have found the top here right around this 4740 area. But Riz, I mean, my gosh, what is fueling this rally? Because I mean, I don't think there's really that much behind it.
Yeah, well, quite a bit. I mean, the Fed came in and they literally injected the market with I don't know, adrenaline or something because they came in and they said, well, we're actually anticipating some rate cuts. Or one rate cut at least, and the market was already pricing in rate cuts, but then that's before they even mentioned rate cuts. So then when they mentioned rate cuts officially, that they're looking into some next year, or at least one, well, then the market further essentially said, oh, okay, you're going to give us one. We were thinking a couple. Oh, we'll add another now. So now the market's thinking, maybe anywhere between 3 to 4 rate cuts. So that could be 75 basis points to 1% as a whole, as a drop in benchmark rates. And what we've seen already over the past couple of weeks is bond yields have come down. And because bond yields have come down, we've also seen Treasury, uh, mortgage rates come down. We've seen all that stuff fall in line. So remember, these things like kind of move in tandem, as I've said many times over. And guess what? They moved in tandem when going up, in terms of benchmark rates going up, mortgage rates going up, yields going up. And then on the flip side, they do so when coming back down as well. So uh, because of that, it's been a perfect storm. Plus, seasonality obviously matters. We've seen earnings be pretty decent. We see inflation come down. We've seen a lot of retail come in, a lot of kind of like FOMO, and then you get this perfect storm, like this absolute, you know, blow. You just come, you blow through everything, like every kind of resistance, everything. Like it doesn't even matter. Like 4,600 was that previous high in July. Boom, doesn't matter. Clear it strongly and then go higher. In fact, we're about like 1.5% or something away from all-time highs. And what benchmark rates are around 5%. Yeah, about 2% to all-time highs, and the benchmark rates are about 5%, let's say, and that hasn't been the case since 2007. Is this somehow warranted? Absolutely not, but here we are. In fact, you can see even on the technicals, the RSI clearly telling you way overbought. And you know, it is what it is. We've seen situations like this in the past. Nothing this extreme. The last time I recall something like this happening, it's almost like this V type of recovery followed by the parabolic move past week. It reminds me of back in 2020 of March. Um, and that was a different scenario. That landscape was very different. So even comparing 2020, post COVID, that kind of rally, um, yeah, I don't even think it's fair to compare. But here we are. It's everything's different. We had benchmark rates were next to nothing, um, pretty much zero. Real rates were essentially negative. But that's not the case now. We got high borrowing costs. We've got inflation that's higher than the 2% average. If you think back 2 years, we literally had 9% inflation. Very different scenario the past couple of years compared to 2020, right? So I am in squarely in the camp that, this is definitely overdone, overvalued. I even mentioned recently on my IG live that the market usually finds a bottom after the pivot, meaning after Fed have stopped raising and then they maybe potentially do a cut or two. The market usually finds a bottom after that. So, in other words, if we go based on history, uh, the market lows are yet to come, right? Does this does this guarantee it? No, but if history is a precedent, then it's something we have to be careful of.
Yeah, I mean, this rally has just feels like it's running on jet fuel at this point, and it feels like almost like the market really just doesn't care. It's like the Fed says rate cut, and they're like, oh yeah, it's going to be the next one. They're going to cut rates next time, and like you said, we're 2% away from all-time highs on the S&P 500, and I have to agree with you. This is way overdone at this point. I mean, it's crazy. I mean, look how extended we are at this point. I mean, we've even just blown past this line here. We didn't even try and come back and test it all but one time. And then we just kind of rebounded and just kind of went to the moon at this point. So very
Yeah.
difficult market to trade in.
Yeah, I mean, if you've been long, you've been on the long side, you've just been holding, you've been sitting pretty, you're happy. I mean, you didn't really need to struggle or do anything for it. You just got this gift handed to you where a blow off top and this massive rip your face off rally was just a gift, really a Santa Claus rally in every shape and form. And great, that's great. At this point, I would definitely be considering trimming, letting go. I know I've said even at the 4,600 level, 4,500 level, start trimming. Um, but that's the beauty of trailing your positions and having a plan of taking incremental gains. Whatever really works for you, but I'm of the belief that we are done in terms of overdone in terms of market structure, fundamentals, macro, everything. It's like all signs are pointing to euphoria, greed, and just extreme extremeness in the market. And every time we see this, it may not happen right away, but every time we see this, it doesn't end well. And by that, I mean, it doesn't necessarily mean it's going to happen in a week, a month, even, or 2 months. It doesn't bode well when you see this level of excess. And 2024, as I've been saying, is going to be that year, that kind of landmark year, which 2023 was supposed to be, where kind of like the buck stops here type of scenario. That didn't happen. The market really skirted, or the economy skirted this kind of cloud that was overcast, that was above, and it just kind of dissipated. And I think 2024 is going to be that time where, okay, are we seeing a hurricane? Are we seeing this tornado come in, or are we completely bypassing it? And if we do bypass it in 2024, then okay, we're good. Um, but if not, then the price, the bill is going to be due for the excess in the market, for the excess spending and the resilience in the consumer sector and everything. So it's going to be very interesting, and it's not a secret that I'm not a permanent bear. I'm not calling for a crash or like the apocalypse, but I am more and more now squarely teeing off into the bearish side, especially the past week, and even since the last time I was on, quite a bit has changed in terms of just technicals. You can see um, the last 2 to 3 weeks have just been way too far. Like I said, good for long positions, good for people that are here, carrying and have been holding. But I'm seeing many different sectors, all different types of companies, a lot of fraud, a lot of insanity, and I don't like it. So take it for what you will. I know there's going to be people that will disagree with me and say, "Well, Riz, you're just being pessimistic," or "Oh, you're just being salty," and I would disagree, but I feel like it's my job to manage risk. It's not my job to tell the future. It's my job to manage risk and kind of um, be sensible, whether markets are absolutely getting decimated or in a scenario like this where they're just going higher and higher and higher and nothing makes sense.
Yeah, I gotta agree with you. I mean, man, what a rally. That's crazy. And yeah, way overbought at this point. So if you're chasing this rally, all I gotta say is be very, very careful. with your positions. But let's take a look here at the breakdown for the S&P 500, and it should come as no surprise that tech was one of the big winners here, making a huge move up from right around the sub 50%, now over plus 55% on the year. S&P 500 itself is up 22% since the beginning of the year. It's just absolutely crazy. Of course, communications and consumer discretionary are right there with the tech sector, making very nice gains. But man, real big jumps in real estate and financials this week, making a very nice push over the zero line, while energy, healthcare, consumer staples, and utilities are all still underperforming compared to the S&P 500 at this point, still below the zero area. So Riz, is there much to be gleaned here, going into the end of the year? I mean, is this really a big surprise that tech is getting this huge boost?
No, not surprising. The pace of this rally is surprising, but no, the fact that tech is leading, and same with XLC communications, which really part of tech with with Apple coming in and all that stuff in there. But even XLY consumer discretionary, the top three being the leaders, and not surprising at all. What you can see is you know, how energy is right pretty much come back to the zero line. Even XLV, which is pharmaceuticals, which was like underperforming and beaten down, also coming near the zero line. And then of course you have XLP, which is consumer staples, and then utilities further underperforming, but they too have mounted a big recovery, especially utilities. Like the slope of that gain for utilities is significant if you think about it. Usually don't move that big, but that's a big recovery. Still below 10% negative on the year to date. But definitely a big recovery. Then that's partly because yields have been coming down, right? And I mentioned on IG Live as well a few days ago where there was a lot of capital leaving utilities because people are like, why should I hold this utility stock, a company? There is risk with that because it's an equity. Why would I, try and hold this for a 3% dividend or a 4% dividend when I can literally just park it in treasury bonds for like 4.5%, 5% risk-free rate, right? So that's a lot of money left utilities. That's why we saw a lot of utilities throughout the year just get hammered and go lower, as money literally was, flowing out of that sector. But it has come back a bit. It remains to be seen how we, end into the year. But I don't personally uh, forecast a big drop. I think we might see some consolidation, a little bit of profit taking as we head into the end of the year. Volume's lower, volatility is also usually lower, and then all bets are off for the start of the new year as we really start from scratch, clean slate.
Yeah, I mean, that is a good point. We are going into the last full trading week of the year. It's kind of hard to believe that. But yeah, that is coming up this week. So be ready because, yeah, if you're in profit from this rally here, yeah, I'd definitely be trimming, kind of like you were talking about. All right, let's take a look here at the asset classes, and not too much going on in oil. Obviously, we had this big sell-off here starting in the end of September, and we have definitely been coming down, really kind of hugging this 70 area. It seems to be really kind of stuck in this zone here. You can see this channel, really just this consolidation for most of December, honestly. So we've been just kind of been bouncing around a little bit. I'm not going to lie, the price of the pump has come down, so I can't complain about that. But one thing that hasn't come down so much is the price of gold. After we had this parabolic move, hit an all-time high, rejected pretty hard, and then bounced right back up a little bit. Gold is here hanging over the 2,000 per ounce, in USD. But yeah, Riz, obviously we've talked about demand destruction with oil. Is there anything else going on? I mean, there's obviously talk about issues going on right now in the Middle East, of course, but obviously that doesn't seem to really be affecting the price of oil at all.
Yeah, it hasn't mentioned last time as well. It hasn't impacted it in the way you would think. You would think, because of geopolitical, geographical instability and the conflicts, that usually it's a bullish thing for oil prices, but hasn't really been the case. It's actually dropped lower than where the conflict started in the Middle East. So that's definitely contrary to the norm. And even with while I was away, even with some of the meetings that's happened with OPEC, potentially extending cuts and kind of continuing on with these cuts into the new year. It's kind of suspect because I presume that some of the OPEC countries, although they have committed to cuts and certain supply constraints, there is a chance where some of them, could be Russia or other countries, they don't have like a hard mandate. Like they're not held to the task. So maybe they are, producing more than they stated. That could definitely be a potential, right? And that's why we see maybe more supply. And as we head into kind of like a slower season for prices at the pump, or I should say, demand for gas. I'm not surprised that we're at the 70 level. It's definitely lower than expected, especially by the major oil bulls and pundits. But yeah, the 70 area, like you said, it's been consolidating. It seems like it's holding this area, so it could be a good support. Even when you go back to April, June, July, nice support area for 70. Um, but again, that's price per barrel. When it comes to oil stocks, oil companies, some remain, um, you know, doing pretty strong with relative strength. You got Shell and the other, some doing really well, and then you have some like Chevron, you got Exxon, you got even Occidental, just kind of like dropping the past couple months and very bearish in that sense. As oil prices just continue to consolidate at the 70 mark. As far as gold, you're right. Nothing much to say in there. Kind of off the highs and just holding above the $2,000 an ounce level is at least good. If it breaks below that, that's definitely bearish.
Definitely something to keep an eye on as we move into the new year. But let's move forward here and talk about these bond yields, because bond yields have just been sinking, pretty much since October. We kind of seem to top out right here about the middle of October, and we've definitely been in a nice little downtrend here on bond yields. The dollar seems to be holding pretty steady. Of course, we came up here to around 106, then kind of pulled back a little bit, but a good ways away from the support level here at 100. So not too much to, see here, in my opinion. But yeah, you alluded earlier to the bond yields decreasing, Riz. What effect, is causing this, and is this something we need to keep an eye on?
Yeah, this is very much to do with potential rate cuts and the Fed signaling rate cuts, market anticipating rate cuts. That's why they're moving down. We know yields and benchmark rates kind of move in tandem, and the market is just pricing in rate cuts at this point. And it's not a surprise that even the U.S. dollar in aggregate has also moved lower, right? Since October, right? So I even mentioned for the past few sessions that I've been on that don't be surprised if you see both the U.S. dollar and yields come down together, and that's precisely what's happened. Uh, how low can they go? How much lower? Could we see 3.5? At the start of the year, perhaps. Yeah, perhaps. But I wouldn't be anticipating much lower than that, I think, because it's not like even if we do get a couple rate cuts, we're not going back to, 2.5, 2% benchmark rates. We're even if they do by some long shot, they end up cutting, benchmark rates by 1% in 2024. Let's assume you're still at around 4% benchmark rates. So at that point, it might make sense for bond yields to be at 3.5. But at this point, no, even at this 4%, I think the bond market and the equities market is, I think, a bit too bullish on I wouldn't say bullish, but like too one-sided in rates and yields coming down.
Definitely something you don't want to do is have blinders on, so to speak, when you're looking at these things, to say the least. So thank you for sharing your insights on that. For all of our people here on the live webinar, and we do have a very healthy amount of people here tonight, if you have questions for Riz, go ahead and start posting them while we talk about the big dates in the market this week. Now, obviously, we got building permits on Tuesday. Not too much exciting here, but this one I think is going to be pretty big. GDP growth rate quarter-on-quarter final for Q3 should be interesting to see. And then we've got some more, things down here that are definitely going to make some impact going into Christmas. We got the core PCE, durable goods orders, not so much, but personal income and personal spending should be interesting to see, especially with November being one of those bigger spending months with Black Friday. Riz, is any of these like really something that you think could move the market in this last full trading week, I should say, or kind of, not too much considering the Fed rate decision last week?
Yeah, I think we had the major catalyst kind of over for the rest of the year. Like you said, personal income spending can kind of give us an insight into how November was from a consumer spending standpoint. And then the growth rate, of course, GDP, we have an idea already what it is. And this is just kind of like that final revision, right? We know that there's a first level and then there's a revision. This is the last kind of revision for Q3. The Q4 numbers we won't know for the full year until next year.
There you have it. All right. So we've already got some questions coming in from our members here. First one came in thinking about shorting ANET at current levels. What are our thoughts? Obviously, a tech stock, if I had to guess, Arista Networks, unless I'm mistaken. But yeah, quite the rally here. But man, with the market going crazy like this, taking a short seems very risky. Riz, what are your thoughts?
Yeah, definitely overbought, overextended. It's a good company. Obviously, you're right, Chris. It's a tech company. But from a technicals, yeah, I think it would be fine for a starter, but just be careful. We know that volume is lower. We know it's a slower time in the market. You don't want to take anything major. If you want to kind of nibble or get your toes wet, absolutely, yeah, you could consider a short, but just be careful. You want to maybe also on a short like this have a defined stop. I don't mean a hard stop order sitting there, but a defined stop, meaning maybe if it goes to 240, you're out. Maybe, a potential trade candidate for this would be 240. If you were to enter at 235.60, let's say on Monday, assuming you get the same price, maybe you have 240 as a stop, and then you target, 230 as profit target one, and then maybe 225 area as profit target two. If you want to be really aggressive, then maybe 220 support, but that's a potential kind of breakdown for you on a trade like this if you do decide to take it.
Definitely a very good way to do it, having that defined stop at least in your head, so you know that if it gets there, you're like, okay, I gotta cut it loose and not chase this thing because man, you don't want to be holding something short for long term. That can go against you really bad. Not to mention the borrowing fees. Don't forget about that. All right, Jeff wants us to talk about Oracle. He said, love to talk about Oracle. I entered around 101. Looks like a pretty darn good entry, if you ask me. Is a full gap fill to the 112 area as a profit target realistic or too aggressive given the macro background right now? Uh, that's a big move you're targeting there, Jeff. I'm not going to lie. But man, that 101 entry was absolutely solid, if you ask me. Bounced off there really nice there on Friday, giving you a nice push. So you're obviously in the profit already. To me, it seems a little aggressive. I would kind of be looking at like at this 107 area right here on the 200 moving average, especially if the market continues to pump this last week. Um, gap fill up to 112 seems a bit aggressive to me. Riz, what are your thoughts?
Yeah, I'd agree. I feel like you're right, with the 200 being a solid potential exit point or a target there. Again, you had a good entry from the 101 kind of support held there. That's really good. I myself am in this trade as well, as you know. Again, a little bit of a different price. But yes, I would like to see it run up towards 105, 107, ideally, before the end of the year. But even if we don't, that's fine. I'm yet to decide whether, take gains on it sooner rather than later, but I would like to see it kind of go up to 105 at least.
Yeah, I think that's definitely within the realm of possibility before the end of the year, if that's something you're looking at. All right, Sean wants us to take a look at BA, which is Boeing, if I'm not mistaken. Way too parabolic. Yeah, you ain't kidding. This makes the S&P 500 look like it's really lagging behind if you use this as a metric. But look at this RSI. Oh my goodness. Now this is what we're talking about, guys. We've talked about this time and time again. We tell you, stocks and securities can stay overbought or oversold for a long period of time. This is about as perfect an example as I can give you uh, as of the RSI being just way overdone. I mean, we're at 92.69. That's nice. But yeah, Boeing going absolutely nuts. If I'm not mistaken, I thought they lost a couple of contracts with the military, which is a little surprising that it's going this crazy. But man, I am not stepping in front of this freight train. Riz, what are your thoughts on Boeing here?
This is funny because believe it or not, 2 weeks ago, we took a quick short, quick little bit made a quick money and then got out, thankfully, because man, it tore off. It just got crazy. Like look at these green candles, like that's significant, you know. If you look back before August, it doesn't move like this, right? Boeing does not move like this. You know, it's pretty volatile, kind of just consolidating, choppy. You know, if you look back in the summer and the start of the year. This is crazy. This is way too overdone. You're absolutely right. Parabolic indeed, overbought, overdone, overvalued, all kinds of things. And as Chris said, yeah, I wouldn't want to step in front of this freight train, but I would definitely consider a short. Again, I did have a short. Remember, like I took a short, got out quickly, thank God, because I'm like, this isn't looking right. And I'm glad my Spidey sense or Riz sense kind of went off and I got out for a tiny profit because man, I would have gone steamrolled here, right? Being short on this rally like this. So yes, there is definitely shaping up for a potential re-entry for a short, but you got to be extra careful with price action like this. Maybe you want to nibble, take a starter, and then once you see that consolidation come in, maybe a curling over, boom, you got your kind of um, second entry for adding to the short.
Yeah, I think you kind of answered his second question there. He asked if we'd consider short if it showed some weakness. I think yes. With something like this, that seems like a pretty easy something to short. Of course, we're not trying to give you financial advice here or how to use your money. Just talking about what we would do. But yeah, this is insane. My goodness, that is nuts. All right, Jeff has another question for us, and I think we'll call it at that because we do have an extra webinar we're going to be doing after this that you'll see as a separate video if you're watching this on the replay. Jeff says he's considering Airbnb as a short as well if it starts to roll over. Well, let's take a look at it. I remember this one. It's just below daily support. Looking at profit target one of 143, which I have as a weekly support area. We'll look at that in just a second. Thesis is deteriorating fundamentals and overbought, overextended. Well, I mean, I mean, definitely overextended. Not exactly a Boeing overextension here, but yeah, wow, look at that bounce off of the 200 moving average there. That is nuts. Just going crazy right at the overbought area here. I mean, yeah, we've definitely been here before. Obviously, in September, we kind of came up to this level and then we dumped off of that. Looks like here back in July, we got a little bit higher, but definitely looks like it's in a good place to kind of come back a little bit. Riz, what are your thoughts on Airbnb?
Yeah, great setup for a bearish potential entry. You can see that red candle there as well on Friday. Uh, yeah, I think if markets cool down, this could at least I would think maybe at least consolidate. I don't see it running too much higher if markets take a pause. And then maybe that'll be enough for it to kind of exhaust itself as profit taking comes in, and then it maybe curls lower. So yeah, you could definitely consider this as a nice technical setup, even like you said, you know, d deteriorating fundamentals. Yeah, potentially that as well. Um, I'm not too big a fan of the company and kind of the kind of ramifications on housing, but that's a whole different conversation. But yeah, from a technical standpoint, absolutely, I think this is definitely a good potential entry, especially as it's at that 146 double top, and then maybe 152, 154 being that secondary resistance point as well.
Absolutely. No, that sounds really good. And, just to kind of, close out the webinar here, just, of course, we're going into the holiday season, last trading week, full trading week, I should say, of the year. Riz, what would you say to, all of our subscribers, all of our, elite members here going into the holidays? What are your thoughts for the year?
Oh boy. It's been another eventful year. Obviously, you know, like Chris said, this the last full trading week. Um, and you know, I would say from a market standpoint, don't overtrade, don't be too aggressive in either direction. I would take things as they come. But then, steel yourself, take that time to maybe recuperate, rejuvenate, whatever the case may be, because 2024 is going to be the year where kind of everything kind of comes full circle. If I can say again, I can't tell the future, but I have this inkling that 2024 is obviously a big year for the U.S. specifically from an election standpoint. We know those years are big, but even from an economic standpoint, I think everything comes around where, I'm sure eventually we're going to see 2% inflation or roughly thereabouts. We're gonna see eventually, I think the Fed do a cut or two at least. We're gonna get more economic data, more, clarity around how you know, the inner workings, the pipings is doing for the US, and that's gonna be big. And if history and past data and past events is anything to go by, it's going to be a volatile year. It's going to be a landmark year. And I think, like I said earlier in the webinar, 2023 was kind of prospected to be that kind of year. And that's okay. It didn't end up being that major of a year, like a keystone year, but usually, when you're off by a year, that's fine. And in that case, 2024 is that year. We will have to see if the US does end up with a soft landing, which is a little bit of an economic slowdown, slower growth, but not a recession. That's the soft landing. That's what you've been hearing about, and the Fed's been going on about for the past year. I am in the camp that perhaps we, you know, maybe go a little bit beyond that soft landing, and it's not a significant or a very substantial recession, but it is potentially a recession. But that's my take. The market feels otherwise. The Fed also sees otherwise. So we will see as the year goes. But I am sure it's going to be a volatile year. It's going to be an interesting year. But apart from markets, I say just take the time, enjoy the holiday season, regardless of whether you celebrate or not. Just take the time to be grateful, kind of recharge because you want to get in the groove of things for 2024.
Definitely get ready for 2024 because it's going to be one of those buckle your safety belts moments, I think. I got to agree with you on that one, Riz. As always, thank you for all of our subscribers. If you do celebrate it, Merry Christmas. If not, have a great rest of your 2023, and we'll see you in the market on Monday.